Gold just had its worst week of the year. In a single session on Friday, June 5th, gold dropped more than $146, settling near $4,300 per ounce. Silver fell even harder, losing more than 7% in the same session. Both metals hit their lowest levels since March, and gold briefly erased all of its 2026 year-to-date gains. The trigger was a single economic data report, and understanding that trigger is what this video is about.
But we have to at least consider we could see more. And Friday made it look like we were heading down that road, with gold falling more than 3%, silver falling more than 7% immediately following the strong jobs report. We also saw
Here are the 5 things you must know about gold's worst week of 2026. This video is not about predicting where gold goes next. It is about understanding what just moved the market. Markets appear to be reacting through a clear cause and effect chain here, which makes this a useful story to understand regardless of where you think prices are headed. Gold's record high in January 2026 was near $5,400 per ounce, with some intraday peaks cited even higher. As of Friday's close, gold was trading near $4,300, roughly 22% below that January peak. On Friday, June 5th, gold settled at approximately $4,340 per ounce, a decline of around 3.3% on the day. That is a drop of more than $146 in a single session. London gold bullion lost nearly 4% from the previous Friday's closing price, making it the lowest London 3 p.m. auction price since the first trading day of 2026. Over the past 4 weeks, gold lost approximately 6.8% of its value. Over the past 12 months, despite this week's decline, gold is still up more than 32%. That last number matters. Gold is not back at 2025 levels. It is back at early 2026 levels. The phrase erase 2026 gains is accurate. The phrase gold has crashed back to nothing is not. One useful way to think about this: gold rose sharply in late 2025 and early 2026. What markets are doing now is repricing that move in light of new economic data. That is different from a structural collapse. On the morning of Friday, June 5th, the U.S. Bureau of Labor Statistics released the May Employment Situation Report. The data showed that the U.S. economy added 172,000 non-farm payroll jobs in May. The consensus forecast from economists was approximately 85,000. The FactSet forecast was 105,000. The actual number was nearly double the estimate.
The next phase of the bull market starts. Now, the trigger for this pullback was a U.S. jobs data report that not only suggests the United States added 172,000 jobs in May versus an expectation of only 80,000, but that more jobs were added to the U.S.
The unemployment rate held steady at 4.3%. The jobs data came in fairly significantly over what was expected. Markets appear to be reacting through a clear cause and effect chain. A stronger than expected labor market suggests the economy may not need help from the Federal Reserve in the form of lower interest rates.
That's the risk. And this week's job data coming in stronger than expected, with 172,000 new jobs in the U.S. when expectations were 80,000, makes that fork in the road look a lot more real. Because the Fed isn't getting pressure to cut the rate with unemployment at 4.3%. And jobs data has a lot to do with their decision, so we see a hot labor market like this, it's going to give the Fed more reason to keep interest rates high.
In fact, it raises the question of whether rates might need to go higher. The national unemployment rate remains steady at 4.3%, and the data was released at 8:30 Eastern Time on June 5th, 2026. This is the core thing to understand, because it is the reason why a jobs report can send gold down by more than 3% in a single day. Gold does not pay interest. It does not pay a dividend. It does not yield anything on its own. When interest rates are low or falling, that does not matter much, because the assets that do pay interest, like government bonds, are not paying much either. But when interest rates are rising or expected to rise, the comparison shifts. Think of it this way. If a government bond starts offering a meaningful return, some investors may find that more attractive than holding an asset that pays nothing. That is the basic pressure gold faces when rate expectations move higher. Markets move to pricing a Federal Reserve rate hike by year-end at roughly 50-50 odds after the jobs report, with some sources citing rate hike probability reaching 67%. The 10-year Treasury yield moved to 4.54%. US and German government bond yields both hit their highest levels in 2 weeks on the session. Gold extended losses because of growing expectations of a US rate hike. Goldman Sachs pushed its call for Federal Reserve rate cuts to 2027 after the strong jobs data. That shift in relative attractiveness between gold and yield-bearing assets is what analysts refer to as the opportunity cost of holding gold. What is still unclear is whether the Federal Reserve will actually raise rates at or after the June 16th to 17 FOMC meeting. Market pricing reflects expectations, not a guaranteed policy decision. Silver's decline on Friday was significantly larger than gold's. Silver fell $5.26, or 7.17%. Closing at $68.57 per troy ounce. Silver continued to trade under pressure, down approximately 2.2% in the most recent session. Platinum fell 2.1%. Palladium fell 1.5%. Analysts describe silver as having a dual nature. On one side, silver functions as a monetary metal, similar to gold, and it responds to the same rate and dollar pressures. On the other side, silver has significant industrial demand. It is used in solar panels, electronics, and manufacturing. When economic sentiment shifts, silver can face pressure from both directions at once. The broader equity market sell-off on June 5th contributed to silver's steeper decline.
Rode with gold falling more than 3%, silver falling more than 7% immediately following the strong jobs report. We also saw bond yields spiking with the 10-year Treasury back above 4.5%. Now,
the Nasdaq Composite fell 4.18% on the session, its worst single-day performance since April 2025. When equity markets sell off sharply, silver can be caught in broader liquidation alongside stocks. The silver market is projected to record a supply deficit of 46.3 million ounces in 2026, widening from a 40.3 million ounce deficit in 2025. That structural supply-demand picture has not changed because of this week's price move. Central banks purchased an estimated 244 tons of gold in the first quarter of 2026.
2026 was that central banks bought 244 tons of gold. But what was verified through IMF data was 2 tons. This means only 1% of
that figure exceeded both the previous quarter and the 5-year quarterly average. The National Bank of Poland was the largest single buyer, increasing its reserves by 31 tons. The People's Bank of China also increased gold reserves by 7 tons in Q1, more than doubling its net purchases from the prior quarter. Gold bar and coin demand rose 42% to 474 tons in Q1 2026, marking the second highest quarter on record for that category. Global gold ETF assets under management declined approximately 2% month over month in May, reaching $604 billion, with holdings easing to 4,121 tons. That represents softer financial market demand in the period before the latest price drop. What this shows is that the structural demand picture and the short-term price reaction are not the same story. Central bank purchases of 244 tons in a single quarter represent a significant demand signal. That does not disappear because of one jobs report. Short-term price pressure from rate expectations and dollar strength is real, but it exists alongside structural demand that has been running at elevated levels for several years. What is unclear is whether central bank buying will accelerate at lower prices, hold steady, or slow. That has not been reported or confirmed for the current period. Gold's worst week of 2026 was not driven by a crisis, a war development, or market manipulation. It was driven by a market reaction to a stronger than expected jobs report, which shifted interest rate expectations, pushed treasury yields and the dollar higher, and made non-yielding gold less attractive in the short term. Silver felt the same pressure, with additional sensitivity from its industrial demand side. Gold is still up more than 32% over the past 12 months, despite this week's decline. The next market-moving moments for precious metals will likely come from US CPI inflation data and the Federal Reserve's June 16th to 17 meeting. Those two events are what markets are watching now. The question for the comments: which of these 5 factors do you think had the biggest impact on gold this week? The jobs report, rising rate expectations, the stronger dollar, silver's dual nature sell-off, or the broader market reaction? Drop your answer below.